Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HILLTOP Holdings INC quarterly report. HILLTOP Holdings Inc. provides a wide range of business and consumer banking services through its three segments: banking, broker-dealer, and mortgage origination. The company's services include business loans and credit products, consumer banking accounts, savings, checking, money market, certificates of deposit, treasury management, and asset management, investment portfolio management, employee benefit accounts and individual retirement accounts, public finance services for municipalities and political subdivisions, advisory and investment banking services, derivatives and commodities trading, agricultural insurance, bond sales, trading and underwriting, mortgage origination, fixed and adjustable rate mortgages, government-backed loans, FHA, VA, USDA. These services cater to both businesses and individuals, making HILLTOP Holdings Inc. a comprehensive financial institution. HILLTOP Holdings Inc.'s stock price has increased by 10.7% over the past year, driven by several key factors. The company's strong financial results, including a significant preliminary gain from the sale of operations and surpassing earnings per share expectations, have contributed to investor confidence. Additionally, HILLTOP has maintained consistent dividend payments for 10 consecutive years, offering a solid dividend yield. The company's decision to list on NYSE Texas and its share repurchase program have also positively impacted stock value. Furthermore, favorable market conditions, including a positive sentiment in the regional banking sector, have bolstered investor confidence in HILLTOP Holdings' future prospects. The primary drivers of revenue growth or decline can be summarized into several key areas. Revenue growth is primarily driven by an increase in non-interest income for the banking segment, which saw a 14% growth in net interest income and 43% growth in non-interest income. Additionally, proceeds from sales and distributions of premises and equipment and other assets increased significantly, contributing to revenue growth. On the other hand, revenue decline is largely attributed to a decrease in trading gains earned from trading activities and mortgage loan origination fees, which decreased by 22.6% in Q3 and 18.2% in YTD. Furthermore, loans originated for sale also saw a decline, contributing to the overall revenue decline. The mixed or neutral impact on revenue growth or decline includes an increase in customer payoffs, which may have both positive and negative effects depending on the context, as well as a decrease in repurchases, which could be either beneficial or detrimental to revenue. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between 2024 and 2025. Net income has increased by 42% in Q3 2025 and 51% in YTD 2025, with a notable rise of $43,769 from the previous year. This growth can be attributed to improved net interest income and reversal of credit losses. However, profit margins have experienced a slight decline. The net interest income margin decreased from 4.1% in 2024 to 3.9% in 2025 for the 3 months ended, and from 4% in 2024 to 3.8% in 2025 for the 9 months ended. Despite this decrease, total non-interest income has seen a significant increase of 8.6% and 8.2%, contributing positively to the overall performance. The improvement in net income can be attributed to the combination of increased net interest income and reversal of credit losses. This shift in financial performance highlights the company's ability to adapt and respond to changing market conditions, ultimately leading to improved results. The company's financial performance indicates a consistent generation of positive operating cash flow. The operating cash flows for both 2024, $151,119, and 2025, $44,193, are reported as positive, supporting this conclusion. This trend is further reinforced by the statement on page 15 that explicitly mentions the company's ability to generate positive operating cash flow. The company's debt level has undergone significant changes over the past 9 months. Notably, the mortgage servicing rights (MSR) asset decreased by $33,469, while subordinated notes due 2030 and senior notes due 2025 were redeemed in full. Additionally, short-term borrowings and notes payable also saw substantial decreases of 19% and 57%, respectively. In terms of interest expenses, there was a notable decline of 17% for the 3 months ended September 30, 2025, and an even more significant decrease of 48.3% for the 9 months ended September 30, 2025. This reduction in interest expenses is primarily attributed to a decline in the negative net interest margin. Overall, these changes indicate that the company has made efforts to reduce its debt level and associated interest expenses, resulting in a more favorable financial position. The financial summary reveals a mixed performance across various segments and regions. The banking segment and broker-dealer segment stood out as top performers, with significant increases in income before taxes of 14% and 56%, respectively. The Texas region also showed improvement, with net interest income and total non-interest income rising by 7% and 9%. On the other hand, the mortgage origination segment struggled, recording losses before taxes of $7.2 million for the 3 months ended September 30, 2025. The mortgage segment also underperformed, with a decline in income before taxes of 57%. The securities holdings segment, U.S., did not provide specific performance metrics, leaving its performance unclear. Overall, while some segments and regions showed strong growth, others faced significant challenges, highlighting the need for targeted improvement efforts to optimize overall financial performance. Management is expressing a cautious outlook for the company's future performance. They anticipate ongoing challenges from economic headwinds, interest rate movements, and deposit costs. The company expects to continue managing its assets and liabilities to mitigate volatility in reported earnings. Management also notes that inflationary pressures will persist, but moderating slightly. Key strategies include managing interest rate risk through asset/liability management policies and derivative instruments, maintaining competitiveness in deposit products and pricing structures, continuing to evaluate the impact of new accounting standards overall. Management is focused on navigating a challenging environment while positioning the company for long-term success. Acquisitions and divestitures overview. The company has made several strategic acquisitions and divestitures over the past year. On the acquisition side, notable transactions include the purchase of government-guaranteed loans under SBA lending programs, interest in Moser Holdings, LLC, and a sale of operations by Merchant Bank Equity Investment, resulting in a pre-tax gain of $28.1 million. The company has also made significant divestitures, including the sale of certain loans held for investment, MSR assets worth $87.3 million, and redemption of senior notes and subordinated notes totaling $199.3 million. These transactions demonstrate the company's efforts to optimize its portfolio and reduce debt. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has declared and paid quarterly dividends since at least October 2025, with each payment amounting to $0.18 per common share. Additionally, the company has also repurchased shares from the market, spending a total of $123.2 million on 3,905,210 shares at an average price of $31.56 per share. Concerns about inventory buildup or supply chain disruption. The financial summary highlights several concerns regarding inventory buildup or supply chain disruption. On page 7, an increase in loans originated for sale and proceeds from loans sold suggests potential inventory buildup or supply chain issues related to loan sales. Additionally, on page 77, inventory positions within fixed income services and structured finance business lines increased net interest earned, but correspondent inventory positions had a negative impact. This indicates that maintaining inventory positions may have a significant impact on overall financial performance due to interest rate risk. A downside scenario on page 94 assumes a recession in the fourth quarter of 2025 caused by tariffs, reciprocal tariffs, and rising inflation, which could lead to supply chain disruption. Furthermore, commercial and industrial non-accrual loans decreased by $17.6 million, but 29 relationships are still considered non-accrual, with inventory mentioned as collateral for some of these loans. International armed conflicts also pose a risk to supply chains, as mentioned on pages 62 and 63. These concerns suggest that inventory buildup or supply chain disruption may be potential risks to the financial performance of the company. That concludes the financial summary for HILLTOP Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.